Here is our second video from Chapter 3 on the corporate income tax. Continuing our discussion of differences between individual and corporate taxable income. The fifth one is net operating losses. Net operating losses are very different from individual in that all you need to know is the corporation's negative taxable income for the year. That is the corporation's net operating loss. So remember, for individuals, we had all those add backs of various things. We do not need to do that here. If you had negative $100,000 of taxable income, that is your net operating loss. So what do you do with that net operating loss? Carry it forward. General rule is you cannot carry it back. But as I said in the last video, sometimes they change that. Sometimes Congress says, well, because of COVID, which is the most recent example, we're going to let corporations carry back their losses so they can get a little bit more money. It's just a way of putting money into the economy. I expect you'll see it again sometime, who knows when, but carrybacks of net operating losses, I predict, are not gone forever. The carry forward does not expire. It lasts indefinitely. And of course, corporations don't have a natural life the way people do. So it could carry forward for theoretically centuries. The loss can be used to offset no more than 80% of the income from the carry forward year. So you cannot bring your carry forward year income down to zero by deducting a prior year's net operating loss carry forward. You can get it down to 20% of what it was, offset the other 80% with a net operating loss, but you can't get it all the way to zero. Dividends received deduction. This is something that is unique to corporations. It does not exist in the individual income tax. You get special treatment for your qualified dividends, special capital gain tax rates, but you don't get a dividend received deduction, which we do get for corporations. The whole point behind the dividend received deduction is that corporate taxable income is taxed and there is no deduction for dividends paid. So the corporation made $100 million and paid the tax on $100 million, which would be $21 million. And then they sent some of that net income out to their stockholders, and the stockholders had to include it in their income as well, and it's taxed again. It's the double taxation of corporate income. You hear about it a lot. Well, what if the stockholder is a corporation? They have now received dividends from the corporation that paid the dividends, and they have to include it in their taxable income, taxed at 21%, and then maybe they send out a dividend to their stockholders, it's taxed a third time. So the dividends received deduction is a way of mitigating, and it is not the same as eliminating, but at least mitigating the potential for triple, quadruple, quintuple taxation of income if corporations own the stock in other corporations. So that's the whole point of the dividends received deduction. That's why corporations get it and people don't. It's designed, as I said, to mitigate the double taxation of corporate dividends. The deduction is based on the percentage owned of the distributing corporation. So you just got a dividend from the XYZ Corp. How much stock in the XYZ Corp does your corporation own? If it's less than 20%, you get a 50% dividend received deduction. So the typical mom and pop corporation went out and invested some excess funds in a New York Stock Exchange company, and then they got a dividend from that New York Stock Exchange company. They probably didn't buy 20% of the company. They probably bought just a few hundred shares, and so they'll get a 50% dividend received deduction. They'll get to subtract half of the dividends that they received. If your ownership is at least 20%, but not 80%, then it's a 65% dividend received deduction. So now you've got a company where you have probably significant influence. Certainly, if you have more than 50%, you have control of the corporation. But even at 20 to 50, you're going to be a significant stockholder. And if you say something to the board of directors, they're going to listen to you because you're a big stockholder in that corporation. So there you get a 65% dividend received deduction. And then if you were at 80 or above, 100%. Now you're talking about a controlled subsidiary. Controlled subsidiary sends dividends to its parent corporation. The parent corporation can subtract 100% of those dividends. You don't have to pay tax on them at all. And so you could imagine you could have several layers, like a parent company, and then a subsidiary, and then under that subsidiary is another subsidiary, and under that is another subsidiary. Well, as long as there's at least 80% control all the way up the line, you could have the third or fourth tier sub sending dividends up the chain all the way to the parent company. None of it will ever be taxed. It's 100% dividend received deduction. Okay, continuing now, for the 50 or 65% deduction, this does not apply to the 100%. It is limited to 50 or 65% of the corporate taxable income. And that's corporate taxable income before the dividends received deduction. Just like charitable contributions, they don't want to make you do the algebra to figure out what it would be if you did it after the dividend received deduction, because the people who wrote the code probably don't know how to do that algebra, and so therefore they don't want to make you do it either. So there you go. So you don't have to count the dividend received deduction in computing your limit on the dividend received deduction. Also, net operating loss carry forward or carry back. Now, in the case of the charitable contribution deduction, it was just carrybacks that you could ignore. It's good to know you can ignore them here as well, but you can also ignore any net operating loss carry forward. So that's nice. And the capital loss carryback. Again, you don't have to go back and modify a prior return because you carried back a capital loss, and so you don't have to go back and redo your dividend received deduction from that prior year. So it's good that the carrybacks are not counted. And again, in the case of net operating loss, you also get to ignore the net operating loss carry forward. Just calculate taxable income before that amount. And this is interesting. The limit does not apply if the full deduction would result in a net operating loss, which is why it would make no sense for it to apply to the 100% dividend received deduction, because if you subtract the whole thing and compare that to 100% of corporate taxable income, well, if you're over 100% of corporate taxable income, you will result in a net operating loss. So there's no point in setting up that limit. So they didn't. Okay, the people who wrote the law they were able to figure that out. All right. So anyway, but for 50 and 65, they've got this little range. If you have the deduction is big enough to get up above 50 or 65%, as the case may be, but not so big that it completely wipes out corporate taxable income, then the limit applies. If it's little, then the limit, you're under the 50 or 65% threshold, so you're fine. Or if it's really big, well, then you would put the corporation in that operating loss position. Either way, you get the full deduction without regard to this limit. It's only if you're in the middle ground that the limit applies. Why Congress wrote that rule, I have never figured out. I've never been able to make economic sense of why that's a good idea in that middle range only. But that's the rule. The requirements for the dividend received deduction: the payer must be a domestic corporation. So if you own stock in Toyota, you get a dividend from Toyota. Sorry, no dividend received deduction for your corporation. That's not a domestic corporation. Toyota is not paying federal income tax to the U.S., so we don't have to worry about whether or not we're double taxing that income. Okay. So payer must be a domestic corporation. The holder has to own the stock at least 45 days. What they don't want is they don't want you buying a bunch of stock on the day before the ex-dividend date. The dividend's been announced, but it hasn't gone ex-dividend yet. It goes ex-dividend tomorrow. So there's going to be your share of the dividend is going to be $10,000. The value of your stock on average when the stock goes ex-dividend will be the amount of the dividend. So you can expect the value of your stock to drop by $10,000. You sell it the day after it goes ex-dividend at a $10,000 loss. Now you've got a $10,000 short-term capital loss. They give you a dividends received deduction, and you can deduct that loss, which of course you can only do if you've got capital gains, but let's assume you do. Then you get a double deduction for that dividend. They don't want that. So they say, no fair. You got to hold that stock at least. They said 45 days. Dividends are generally paid quarterly, which is approximately 90 days. So you got to hold it for at least half of the term between dividends, 45 days approximately. And if the payer pays an extraordinary dividend, then they're going to make you reduce the basis of your stock. Recipient must reduce the basis of the stock by the amount of the dividend received deduction. So how much is an extraordinary dividend? Well, if it's common stock, 10% of basis will count as extraordinary. For preferred, 5% of basis. Now, you wouldn't expect to see extraordinary dividends on preferred. So they got a fairly low threshold there, but I don't think you'll ever run into it. Preferred stock, they have a set dividend, and that's it. They don't generally go over that amount. For common stock, they very well could. And no basis reduction is required if you held the stock at least 2 years before this extraordinary dividend was declared. So again, they're worried about people just trying to play games with the dividends and the dividend received deduction. And an extraordinary dividend is going to get a big price drop in the stock. If there's extraordinary dividend on preferred, that would cause a price drop in the preferred as well. And so they say, well, if you've been holding this stock for 2 years, we're not going to impose this limit. But otherwise, we absolutely will. Problem number 49. During the current year, Swallow Corporation, a calendar year C corporation, has the following transactions. Income from operations, $660,000. Expenses from operations, $760,000. Notice that their operations is putting them in a loss position. Anytime you get a question on the dividend received deduction, if the operating income is positive, the limits will not apply. You'll see how that works in just a minute. So anytime you see on the CPA exam, if they give you a dividend received deduction, the chances are very high that operating income will be negative, as it is in this question. Okay, the dividends received from Brown Corporation, $240,000. Swallow owns 12% of Brown Corporation stock. How much is Swallow's taxable income, or NOL, for the year? So gross income from operations, $660,000. Expenses, $760,000. So we have a net operating loss of $100,000. But dividends received were $240,000. So we're back into positive territory of $140,000. 50% of the dividends received is $120,000, but 50% of operating income before dividend received deduction is only $70,000. That 50% of operating income limit will apply. So our dividend received deduction is only $70,000. Taxable income, therefore, is $70,000. Letter B says, let's assume that Swallow owned not 12%, but 26% of Brown Corporation stock. How much is Swallow's taxable income now? Well, now, first of all, gross income operations and expenses have not changed. We still have our $100,000 operating loss. The dividend is still $240,000, but now the dividend received deduction is 65%. 65% of 240 is 156. 65% of 140 is 91,000, but we don't care because 65% of 240,000, if we take that, that would put us into a net operating loss position. So we get to take it, the full 156. Taxable income is therefore a net operating loss of 16,000, which we can carry forward and try to deduct it next year. So there you go. For this particular situation, we're in that range where the dividend received deduction in full is big enough to put the corporation into a net operating loss position. Now let's do Part C. Part C does not exist in the textbook. I made it up myself. Let's say gross income from operations, $660,000. What I changed was expenses. Instead of $760, I said, how about $780? So our net operating loss is now $120,000. Dividends received $240, and we'll go back to letter A where it was a 12% ownership, so we get the 50% dividend received deduction. Income before dividend received deduction of $120,000. 50% of 120. Try it again. 50% of 240 is 120. 50% of 120 is 60. We just read the rules. If the dividend received deduction would put us in a net operating loss position, we can take the full amount. But if not, then we can only use the limited amount. Well, it doesn't put us in a net operating loss. Close, puts us at zero, but that's not a net operating loss. So here's your rule, 60,000. And therefore, taxable income is 60,000, and the tax is 12,600. But you're working on this client, and there's their tax return, and you say, well, okay, I guess that's it. Tax is 12,600. Do you accept that? My answer is you absolutely do not accept that. That tax return hasn't been filed yet. Go back to your work papers. Take a look at those expenses. They are full of estimates. Suppose there was a utility bill. And what do you do every year? You say, well, the utility bill runs from November 30th to December 30th. So, okay, so fine. So that we accrue that utility bill payable in January. We accrue that as an expense, but we don't bother accruing the January bill from December 31st to January 30th. That's silly for the extra $5 of electricity that we used on December 31st. No, we're not going to bother accruing that most of the time. Here, though, yeah, I think there is a reason to do that. Let's change that expense to $780,005. Let's accrue that $5 worth of electricity expense for December 31st. It happened in the current tax year. Why not? That makes our operating income negative $120,005. Dividends received is $240,000. That gives us income before dividend received deduction of $119,995. Full dividend received deduction is $120,000. The 50% of income up to that point is, it's actually $59,997.50, but I rounded it anyway. But we don't care what that number is because we can take the full dividends received deduction because it will put us into a net operating loss position of negative $5. So we can take the full amount. We just saved our client $12,600. We also have a $5 net operating loss carry forward. That's no big deal. But we saved them $12,600 on the current year return. We should do that. I say we should absolutely do that. And if you find yourself in a position like that, don't just go back, make the adjustment, bring in the $5, change the return, and just hand it off to the supervisor. Say, okay, this return's done. What's next? Let them know what you did. Now, you can't just go brag about, look how brilliant I am. I mean, you could do it that way, but I think the best way to do it is to go to the supervisor or the supervisor's supervisor or the tax partner and say, I want to check something with you. Normally, we don't accrue that electric bill, but because of the situation, I did accrue the extra $5 because it saved the client $12,600 in tax. Is that okay that I did that? You know, I'm new here. I don't know the rules, but it seemed to me that I should do it. Is that all right? Do it that way. They will, number one, and I guess they call that the humble brag, right? Maybe they know you're bragging, but at least you don't come off as, look how brilliant I am. You check with them. Hey, was that all right that I did that? Make sure they know you did it. Because the one thing you don't want to do is do something brilliant like that, save your client $12,600 and not let anybody know about it. Also, by the way, they will probably find a way, the partner will probably find a way to let the client know that our firm just saved you $12,600. They may or may not give you credit for that. They should. Whether they do or not, I don't know. Depends on the firm. But they'll want to take credit for it too. So everyone will want to take credit for the wonderful thing you did. And the people in the firm will know you did it and they'll remember. So do that whenever possible. And make sure that you let people know you did it one way or another. Again, without overtly bragging if there's a way you can get around it. Okay. The tax, by the way, well, the tax is zero. Okay. Organization costs. Here's something individuals don't have. We don't pay organization costs. These are the costs of bringing the corporation into existence. Costs of bringing an individual into existence are called medical expenses. But for corporations, they're called organization costs. And they include things like legal fees, incorporation fees. You got to pay the state something. Maybe accounting services. So again, you wouldn't have to do it for your own corporation, but you would for your client. And there might be organization meeting costs if you have to gather people from out of town to get together to sign all the documents and whatnot. There may be travel expenses and other things like that. Do not count costs of issuing stock. Those are not deductible. So in terms of if you're going to issue stock, that just becomes a charge against the capital stock account. Just debit additional paid in capital if you've got a credit balance there. Then that's what you would do with that. But it's not deductible, so there's no tax effect of the cost of issuing stock at all. Costs must be incurred before the end of the first fiscal year. They don't have to be paid, but they must be incurred. Even if you have a cash basis taxpayer, you can count any costs which were incurred, even if not paid, but it's got to be before the end of the first fiscal year. That might affect what you choose for your fiscal year. If you did all this in November, you might not want to choose a calendar year if some of the costs wouldn't be incurred until January. Okay, so got to be before the end of the first fiscal year. Usually it's before the corporation even gets started, but there might be some things that actually are incurred after the corporation has started doing business. Generally not, but it could happen. You can deduct the first $5,000 outright, and then anything over $5,000 you have to amortize over 180 months. That's 15 years, but on a month-to-month basis. And if your total exceeds $50,000, then you have to reduce your $5,000 immediate deduction dollar for dollar. So if you're at $51,000, well, then only the first 4 can be deducted immediately under that immediate deduction organization. The last 47,000 would have to be amortized over the 180 months. And if you're at 55,000, then you've reduced the immediate deduction down to zero, and everything has to be amortized over 180 months. Problem number 53. In each of the following independent situations, determine the corporation's income tax liability. Assume that all corporations use a calendar year for tax purposes, and the tax year involved is 2024. This is actually, this is a dumb question, and I'm not going to cover it next year. But I assigned it, and it was too late by the time I had assigned it to take it back. So I said, all right, we'll do it. The problem is, I think this question was written back when we had a corporate tax rate schedule for corporations, started at 15% and went all the way up to 35%. We don't have that anymore. And so all you do is you take taxable income and multiply by 21%. So the purple corporation with taxable income of $65,000 is going to pay a tax of 21%, $13,650. Azul taxable income is $290,000, and the tax is 21% of $290,000, which is $60,900. Pink taxable income $12,350,000, 21% of that is $2,593,500. Turquoise taxable income is $19,000,000, 21%, $3,990,000. And teal, which is a personal service corporation, we don't care, it doesn't matter, $130,000, and 21% of that is $27,300. So this probably was an interesting question under old law. Under new law, it's not very interesting at all. It's just a question, can you multiply all these numbers by 0.21? Yes, we can. Okay, there you go. So that's 53. Now, before we do the final question, we have the corporate alternative minimum tax. This is fairly new. This was just enacted a couple of years ago, and it is the U.S. attempt to comply with a general agreement that the U.S. and a lot of other countries around the world made, that we will have a minimum tax of 15% on corporate net income. They say, well, we have 21%, so we should be good. But they say, well, no, because there are so many ways that corporations can reduce their taxable income relative to their reported net income, that they're not really paying 15% of the amounts that they are reporting to their stockholders. So they said, all right, we're going to create a corporate alternative minimum tax, and the tax is going to be based on adjusted financial statement income, which is given the little acronym AFSI. So adjusted financial statement income. So this is based on GAAP or IFRS, but it is financial income. So it is the income that you compute using the rules in 301, 302, and 440. That's what you need to focus on for this tax base. It applies to any corporation that's not an S corporation if it has, here's the kicker, adjusted financial statement income of over $1 billion in the 3 tax years preceding the current tax year. But once you meet that requirement, once you've hit it once in any year after 2021, you are permanently subject to the AMT. So you can't drop down to 990 million for a couple of years and say, okay, it no longer applies to us. Yes, it does. Once it starts, it continues forever after that. Now, adjusted financial statement income. Focus on the adjusted. So start with financial statement income, but we're going to adjust it. First of all, add back your book depreciation expense. Well, that's no fun. We just made it bigger. But that's okay. The other thing is you have to add back your provision for income tax. Because, of course, taxable income is pre-tax income. So that's not fun, but the good news on the depreciation is you get to deduct depreciation that you computed on your tax return, which is probably bigger. May not be if you have very old assets. Generally speaking, tax depreciation is bigger than book depreciation in the early years of the assets. For most corporations that are continually renewing their asset base, that's going to be good news that you can deduct tax depreciation. It may not be for all situations, but I regard that as probably good news in most cases. So you do have those two add backs, but the deduction is going to be better than the add back for the book depreciation anyway. What you actually picked up as your provision for income taxes, I don't know, that could be something very different. And to tell you the truth, I don't know that much about it because I don't teach that. I teach how to calculate the actual tax, not the provision for income taxes. Anyway, the tax depreciation, yes, that includes makers and Section 179 and bonus depreciation. So that could be very good news. There's other adjustments that may apply. Our textbook doesn't refer to them. I actually don't know what they are, but I do know that the big two that are going to be the most common are depreciation and provision for income taxes. The minimum tax is equal to 15% of AFSI. That was what we agreed to with the rest of the major economies in the world. It's minus any AMT foreign tax credit. So if you've got foreign tax credits because you had to pay taxes to Japan or Germany or someplace else, well, then you do get to subtract that out. And the alternative minimum tax, so that was the tentative minimum tax. The alternative minimum tax, this is just like for individuals. Alternative minimum tax is equal to the tentative minimum tax minus the regular income tax if that is a positive number. So you pay the greater of the tentative minimum tax or the regular income tax. And so they say you're paying at least 15% of AFSI, which is the deal we made with the other countries of the world. So problem 54, we'll finish with that. Crockett Corporation is a calendar year C corporation reporting net income of net income of $1.7 billion on its 2024 audited financial statements. That includes federal income tax expense of $300 million and financial statement depreciation of $250 million. Also for 24, Crockett reports taxable income of $1.2 billion, including tax depreciation of $400 million. Assume that Crockett's average annual AFSI for the 3-year period ending December 31st, 2023 is in excess of $1 billion. So they're subject to AFSI. Also assume Crockett has no AMT foreign tax credits for 2024, so we don't have to worry about them. Compute Crockett's 2024 AMT. Okay, so net income is $1.7 billion. Financial statement depreciation, $250 million. Provision for income tax, $300 million. Add that up and you get $2.25 billion at this point, but our tax depreciation was $400 million. So AFSI, adjusted financial statement income, $1.85 billion. Multiply that by 15%, and our tentative minimum tax, $277,500,000. Taxable income is $1.2 billion. Multiply that by 21%. Regular income tax is $252 million. So the tentative minimum tax is the difference between $277,500 and the regular income tax of $252, and that is an alternative minimum tax of $25,500,000. One more thing before we finish chapter 3. It's very quick. That is corporate taxes on accumulations. There are two types of taxes that are designed to discourage excessive corporate accumulations. Basically, in other words, you say double taxation of corporate income. I hate that. And so therefore, we're not going to pay any dividends, and we'll avoid double taxation of corporate income by not paying dividends. So there won't be any double taxation. So they said, well, we're going to set up an accumulated earnings tax if you overaccumulate earnings, and also something called the personal holding company tax, which again is a tax discouraging excessive corporate accumulations of earnings. These taxes are discussed briefly in the text on page 321, just the bottom half of the page. And therefore, they are outside the scope of this course. They used to be in the scope of this course. We did cover them when we used the old textbook, because that book devoted an entire chapter to the accumulated earnings tax and the personal holding company tax. So we covered it extensively. We're not going to do that here because our textbook doesn't cover it. Instead, what we've substituted is chapter 8, where we're going to talk about consolidated tax returns. Those are tax returns where we have a parent company and one or more subsidiaries. That was not covered in our old course, but we'll be covering it in this course. So no more accumulated earnings tax, personal holding company tax. You could run into it in the CPA exam. And so you might want to familiarize yourself a little bit before preparing for the exam, but our textbook doesn't cover it, so it's gone. Well, that's it for chapter 3. We'll start next time on chapter 4.